the way we structured this is Jean-Charles, as he sees everybody's portfolios, and he sees all the institutions every day of the week, is going to start with an overview of all the allocations between private equity, venture, all the various issues with that. Then we're going to go into the more specific areas with Marlene in the secondaries market, how you use secondaries to change your asset allocations. Moving on to Natalie to explain to everybody why one would want to invest in the leveraged loan market as part of that, and the asset allocation within the leveraged loan market. And finally, we're going to end up with the property end of the spectrum, which is changing, especially in Europe, very much, and to speak to basically a US-European outlook on the changing views on property asset allocation within the portfolios. I'd like to start with Jean-Charles.
Thank you, Humphrey. What I'd like to start with is making sure that we all agree, otherwise we wouldn't be here, that private equity is a great asset class. It can and has demonstrated that it can over time produce superior, partly decorrelated returns and really enhance the performance of an overall investment portfolio. If, and that's a big if, the private equity allocation is managed sensibly, and that is not easy. There are many, many constraints in establishing and then managing a private equity allocation. I think it might be useful just to go over some of those constraints. I think maybe the first slide, Humphrey. I think a good way to do that is really by contrasting the allocation process in public and private markets. Here we go. For those of you who manage a public market investment portfolio, it's probably even more key to allocate properly, i.e. to find the proper mix between cash, bonds, equities, currency exposures. That will be the overwhelming contribution factor to your performance. The choice of vehicles to implement the strategy being really quite a distant second. Well, it's not the case in private equity. Allocating to the right strategy is very important, but it's not the sole factor. I would argue that manager selection is probably equally, if not more important. And I think the next item, not the next slide yet, I'm afraid, but the next item, which is performance dispersion, really proves that. I think that was touched on by the previous panel, so I don't want to repeat too much, but in the private equity sector, if you look over long periods of time, between the average performance of your top quartile managers and bottom quartile, it is on average going to be about 20%. 20% may be more than the overall performance of your private equity allocation. So it's very significant, 2,000 basis points. And that will go from something like 30% plus in venture, 20 roughly in LBO, going down maybe in property to something more like 10. By contrast, public markets, the standard deviation is going to be something around 2%, starting with less than 1% in fixed income strategies, going up maybe to 4% in international equities. But it's really not that significant. Liquidity, again, we're talking about an asset class in private equity which is extremely illiquid. Not only is it very time-consuming to get into the asset class, heavy due diligence process. You may be, once you have chosen a strategy and a manager, you may be depending on the funding cycle of that manager. Public markets, overnight. You can go in, you can go out, easy. Critical size of your asset under management. In a public portfolio, publicly traded portfolio, you really can have a balanced allocation with very little money if you think about it. Well, private equity is not a poor man's game. I mean, if you think of the ideal global allocation of a private equity portfolio, I mean, it would look, the matrix would look something like this. On the left, you'd have all the spectrum of strategies, starting with venture, and within venture, IT, telecom, healthcare, early stage, late stage, LBO, large LBOs, mid-market, small, expansion, mezzanine, distress, property, and on. The top, you have the regions: Europe, Americas, Asia, others. Within the regions, country funds, multi-country funds. Before you know it, you're looking at a matrix with probably 100 boxes to tick. You need manager. You need manager diversifications. That means probably several funds in all of those boxes. It's a multi-billion euro strategy. And plus, having your finger on the pulse of all those markets, knowing really who the good managers are. So it is almost theoretical. Very few institutions in the world have this capability or this amount of money to allocate to private equity. So you'll have to choose. Well, finally, access. You may have selected your strategy, you have identified the managers that are the best within these strategies. You may not be able to get in if you don't have a relationship. Or maybe they're not going to fund for another 3 years. Or it's going to be an invitation-only funds, as some of the better established, better performing funds turn out to be today. Public markets, really no barrier. You know, you can get into virtually any open-ended fund anytime you want. I think if you can put the next slide, Humphrey. I think, you know, if that was not enough, there are other constraints, and I want to go quickly over this. Essentially, the first three are areas which are limiting the flexibility for you to allocate, and they can be because you have as an investor, you have a limited mandate. Funds are funds, say, I'll do European mid-market LBOs and 30% venture, and that's it. Or it can be self-imposed in family offices. You know, you want to stay within certain sectors. There could be regulatory impediments to implementing your strategies. And finally, inertia. I mean, we already touched on this when we spoke about the illiquid nature of the asset class. Really think of a private equity allocation a little bit like a super tanker. It is really slow to get to cruising speed. And when it is there, you don't turn it on a dime. Now, allocating to funds of funds, allocating to secondary market players will probably accelerate the pace of getting to speed, and a little bit of side wind to help in the turns, but you're still talking about a strategy which is not an agile strategy. So you say, well, do we really want to be in private equity with all those constraints? Definitely so. I think you have to observe some rules, and that would be the next and last slide. And if you do, you're going to be successful. And they're basically common sense principles. First one, never get away from that rigorous manager selection. This is really not the topic of this panel. I think the topic of this panel is really more about investment strategy, selection and mix. But it is crucially important. There are simply teams that are going to be better than others at making you consistently money. Differentiation. Look for differentiated strategies. I mean, Alan Patrikoff at Apex had amusing way to put it, say, look for the unfair competitive advantage. As a placement agent, I can tell you we probably interview something like 200 GPs in any given year. We probably review about the same number of PPMs. I still have to see one PPM where you're not going to see that the fund has a unique positioning and that the team has proprietary deal flow. So it's very difficult to really find that gem of differentiation. I mean, you have to look deep in it, but it often exists. It can be in the niche strategy, it can be in a very a meaningful network of relationship. It can be in some domain knowledge that they have and other peoples don't have. Diversification, golden rule of investment management. Diversify, diversify, diversify. Diversify your strategies, diversify your managers, diversify your vintage years. So don't put all your eggs in the same basket. And I'm encouraged that this message is getting across investors. I was reading the latest Frank Russell Goldman Sachs survey of a very large, broad section of institutional investors across the world. Special situations, which is everything but LBO, expansion, venture, mezzanine, has gone between 2001 and 2003 from 8% to 14% of private equity investments commitment. It's very significant, so almost double in those 2 years. So there is diversification is coming in. But, you know, not putting all your eggs in the same basket is not sufficient, because if you have several baskets but all your eggs hatch at the same time, you really haven't achieved diversification. So you must look for non-correlated or loosely correlated strategies. I would argue that if you invest in an Asian distressed fund, distressed debt fund, and in a US healthcare fund and a European mid-market LBO fund, there is no correlation, very little correlation. So do look for non-correlation in the drivers to performance of the teams you will back up, and also non-correlation in the performance cycle of the strategy, which may not all be in sync. Consistency. Once you have an allocation, once you have decided on a certain mix of strategies, don't turn around. I mean, keep investing. Of course, you can weigh your yearly allocation, you can add the margin, but keep investing in all of those asset classes quite regularly. I think this has been the basis of the success of the endowments funds like Yale and Harvard in the United States. They've been there year in, year out. Good vintage years, bad vintage years. Yes, you can use the secondary market to change a little bit the duration, alter the mix, but try to avoid the drastic changes. And finally, what I believe very much into is don't follow the money blindly. I think there is a strong correlation between the dynamics of fundraising in a strategy and the evolution of returns in that strategy. I mean, the best example is the venture euphoria of the late 90s. So avoid the herding instincts. There's just too much of me too. You have to try to detect the early signs of overfunding in a strategy. It's not easy, but there are some reasonable statistics, and you have to be in the market, but you can do that. It's extremely important. Think out of the box. I mean, don't hesitate sometimes to be contrarian or creative. And I would like just to read to you just a sentence. It's a big financial institution, Anglo-Saxon, that is going to start deploying. It's a new allocation to private equity. And in formulating really their plan, one of the sentences, we wish to be at the forefront of changes, e.g., in establishing and calibrating the scale and timing of the developing interests of institutions in specialist assets classes such as emerging markets, distressed debt, mezzanine, PF5, for those who don't know, that's property, in addition to the mainstream buyouts, expansion capital, and venture classes. So on that I will finish. As I started, it's a great asset class, but if you want to make money at it, use some discipline.
Thank you very much.
Just briefly, not so much on this slide, but secondaries, for those who are not quite so familiar with it. It is very much the focusing on the purchase of positions in funds or the purchase of portfolios of illiquid private equity type of investments by funds such as Green Park, but there are obviously quite a few players in the market who do similar things, albeit with different strategies, for an activity that has been established to provide liquidity for investors who, during the lifetime of a private equity fund, which typically is 10 years plus, which is a very long time, and an awful lot can happen to an institutional investor during 10 years who needs liquidity because of a variety of factors that might influence their strategy of investing in this asset class over time. So why? There are actually two angles to secondaries, simply because of the factor that Jean-Charles already mentioned, liquidity. The supertanker aspect of this type of activity means that liquidity is a major issue. The secondaries market has developed in a major way over the last, well, certainly over the last 5 years, and in the US also the 5-10 years prior to that. It has become a major help. It's oiling the wheels, if you like, of private equity. It allows people to get out when technically, per the limited partnership agreement, they can only get out of an agreement and get out of their obligations if and only if they find somebody else to replace them in that partnership. That makes investing in secondaries a very attractive proposal to institutions in terms of diversification within their private equity portfolio. First of all, because we buy during the lifetime of the fund, we typically actually see deal flow in funds that is sort of 4, 5, 6 years old. The funds are typically quite mature, 60, 70, 80, 90% invested in quite a number of cases. The cash flow from the distributions of that portfolio is imminent. Sometimes we buy portfolios where within 2-3 months we get, well, not always, but we've seen situations where within that period of time we get a major percentage of our cost back. And if it takes 2 or 3 years to make a very attractive return to investors, that is still pretty quick. If you compare it with the 5 years money out on your typical J-curve in private equity, and then the money starts coming back. Agreed, we don't necessarily make the 2-3 times multiple either, because of course the seller knows what's in there too. But in combination, it still makes a very attractive early cash flow, allowing for attractive returns. Jean-Charles already indicated another important factor in your asset allocation, diversification. Well, it doesn't come a whole lot more diversified than an investment in a secondaries fund, whatever the underlying strategy is. One would typically, with a fund of X 100 million, end up in 30, 40, 50, if not more, underlying funds with, on average, perhaps 10, 15 companies at the time we're buying after those 5-6 years that the fund has already been in existence. So the diversification is quite extreme in that situation. Even if we tried to actually concentrate on a certain sector, we couldn't, because it's very opportunistic. It depends on who is selling what. So we see in our portfolio literally every single industry sector you can imagine. We get a very nice vintage year diversification. You get a lot of manager diversification. A lot of sellers sell a whole portfolio of assets, 20, 30, 40 funds. Very nice manager diversification indeed. Geographically, well, secondaries funds buy in the States, they buy in Europe, across the various countries. Again, actually very impossible to concentrate on any particular area. It's just, what do you not do? And we would typically not do Eastern Europe or South America emerging markets. But across the States and Europe, you get enormous diversification nearly automatically. Another attraction is visibility. It compensates very nicely for the non-visibility when you invest, as you would have to do as a large part of your allocation, in primary funds. Investing in secondaries funds means that you're investing in a fund, again, buying in year, on average, let's say year 5, that has visibility on the portfolio of the underlying funds. Very attractive, a much more reduced risk profile if you combine it with the risk diversification. So very complementary to your primary strategy, whatever you feel is appropriate on that part of your private equity assets. A technical point, a lot of people say, yes, but hang on, if we invest in a secondaries fund, that's like a fund of funds, and then we pay an extra fee and carry, and we don't like that. Well, fund of funds is not really what we're addressing here, but even there, it's probably worthwhile getting the diversification if your private equity asset allocation is not that voluminous. But in secondaries, we can actually, because we have visibility on the underlying assets, we can actually see what's in there, assess the value, and adjust our purchase price, which is not fixed. It isn't whatever the seller has paid in. We actually pay based on what's in the portfolio left at the time of our purchase, adjusted for the fee and carry. So structure, it is technically a fund of funds if you invest in a secondaries fund, but the pricing takes into account the extra fee and carry. So you don't actually get clobbered twice with the fee and carry, only once. Briefly going to how has the deal structure in secondaries diversified more. What you would have seen, say, 5 years ago, is that typically a deal involved 1 or 2 private equity fund positions. Over time, we've seen a lot more different type of transactions, more complicated, much larger portfolios, which makes the whole process in terms of negotiations, analysis, due diligence, pricing, and closing, getting the transfers done with all the general partners, a lot more complicated. However, if you decide to go to secondaries in your asset allocation, it means that also with quite a few parties having now been in this sector for quite a number of years, 10, 15 years, you can really find specialists who know how to do that and who can make you a very attractive return. This gives you a bit of an indication what you could expect in a secondaries fund. The red circle gives you where traditional secondaries, i.e. secondaries of positions in funds, would be in a fund that is raised right now or say over the last 2 years. So vintage-wise, you would see a concentration probably on 99. You would still see quite a bit of 97, 98, and then coming forward, but tapering off. Next year will probably, a fund that's raised next year will move on a little bit. I won't go into the green one, that's a different type of secondary, but an older type of secondary would take all the years. We're not seeing that many of those quite yet. Give you a bit of an idea who is selling and why. A typical initial reaction to secondary investing when an institutional investor is approached by a secondaries fund is, why would I want somebody else's rubbish? And the fact of the matter is, it actually isn't, well, in most cases, isn't rubbish at all that we're buying. We don't want to buy rubbish. If somebody wants to sell rubbish, I don't know where it goes, but it doesn't come to most secondaries players because we don't want it. Even 10 cents on the dollar for rubbish still is rubbish and could very likely result in rubbish returns. So no, thank you. We buy good assets, but we buy it from, for example, in 2002, you see a big allocation to corporates that provided our deal flow, 35%, very much going together with, on the right, the reason for selling, simply a need for cash. Now, if you need cash, you don't sell rubbish for nothing. You sell good assets for a fair price. In 2003, that's shifted to banks. They needed to either get out of private equity or for regulatory reasons at least adjust. Again, you don't do that by selling rubbish. You sell good assets at a good price. So just wanted to put that into your thinking. When part of your allocation in private equity might go to secondaries funds, you get good assets, very diversified and very complementary to your primary asset allocation. It's a very attractive diversification within your private equity allocation, gives you the early cash flow to complement the later cash flow from the primary funds and reduces overall your risk profile. So very attractive, and we would certainly expect investors that are recently new in private equity to do a large percentage of their portfolio in secondaries funds and then reducing it a bit as one goes on and becomes more experienced in the private equity allocation.
Thank you very much.
I would like to focus on the allocation strategies we can implement in the European leverage loan environment, and maybe first, as a background, explain how and why AXA IM decided about 4 or 5 years ago to expand on the European leverage loan market. Just as a reminder, AXA Investment Managers is one of the 2 asset managers of the AXA Group, the other one being Allianz Capital in the US. We manage above 300 billion euros of assets. AXA IM traditionally has been a very strong fixed income player, and in the fixed income area, a very strong credit player. The decision back in 1999 to expand on the European leverage loan market and asset class derived from the identification that the leverage loan asset class was providing a very attractive alternative investment opportunity for traditional fixed income investors. The main reasons for this being that the leverage loan market was proving to be highly, to provide a high level of diversification, high level of stability, predictability of cash flows and returns, and last but not least, high recoveries. So, as such, the decision to move on the leverage loan market was a real allocation decision, a strategic decision for AXA Investment Managers, which led to putting in place specific teams dedicated to this business. On the next slide, no, not this one, sorry, no, we'll find it. This one. This is the illustration of what is our universe for investment and how can allocation process lead to a real portfolio construction. Asset type, obviously, we invest, so our main job is really to build portfolios based on leverage loans that we buy to arranging banks, either on the primary or on the secondary market. We invest through the risk curve from the senior secured debt to the mezzanine debt, including second lien, which is a more marginal sub-asset class for the moment, but which has really emerged recently on the European market. So asset type allocation is really the result of the decision of level of risk we want to put in a portfolio. Then obviously allocation will also result in decision as to how to build the portfolio in terms of country selection, in terms of industry selection, which I did not put in that slide, in terms of currency split. Market segment, par near par should read 90%, sorry. Market segment is more an indication as to the level of risk we want to allocate in the portfolio and the level of volatility associated. In the next slide, in fact, there are two types of allocation we complete in order to build our portfolios. The tactical allocation is pretty much the result of a bottom-up analysis. This is the most commonly shared type of allocation that leverage loan players perform on the market. It is a key aspect because, as Jean-Charles said earlier, selectivity is really one of the key aspects to get the performance at the end, and a rigorous and very disciplined investment process has to be there. So tactical allocation really consists in, after having sourced and selected a certain number of names on the market, a very extensive credit due diligence will lead to selecting an issue to be put in the portfolio, yes or no. And the second step of this tactical allocation will really be to allocate in terms of risk reward, the level of risk we want to put in the portfolio and the level of return we want to put in the portfolio, considering, on this specific issuer. So this is traditionally on the leverage loan market, the tactical allocation has been really the most predominant way of building the portfolios. What we do additionally in AXA Investment Managers is really perform a complete strategic allocation, and maybe we can go to this slide. Strategic allocation being the result of a more top-down analysis. Again, this strategic allocation consists in 2 steps. The first one is really shared all across AXA Investment Managers, where all strategists, economists, credit analysts, and portfolio managers meet every 6 weeks in order to express their medium-term views and reach a consensus as where do we think the market are going to go in terms of country, in terms of industries, in terms of currencies, in terms of interest rates, in terms of every macroeconomic parameter that can have an influence on your performance ultimately. Once this step is reached, the portfolio managers will then implement those commonly shared views in their own portfolios. The second step of the strategic allocation we perform, and this is very specific to our team in the leverage loan area, is depending on our anticipations about the spreads on the market, depending on our anticipations about the risk profile of the market, then allocate between the different sub-asset classes that are available in our universe, i.e. more or less select between the senior secured loan and the mezzanine debt. As an illustration of that, for example, about 18 months ago, our portfolios were like 80% of senior debt and 20% of mezzanine debt. Because we believe now the risk profile on the market is increasing sharply, and because we believe the risk return, the risk reward on the mezzanine debt is not increasing alongside, we've decided to reallocate a bit more on the senior debt and a bit less on the mezzanine debt. I think the main conclusion, and I don't have a slide for that, but the main conclusion I would like to draw is clearly to us the strategic allocation is really an additional way of bringing value in the performance for the investors. However, there are limitations to the capability of the manager to perform a real strategic allocation, and this limitation comes from the market. It comes from the liquidity available on the market, because depending on your horizon for allocation, you would want sometimes to migrate your portfolio and rebalance your portfolios to other types of allocations. And the second limitation comes from the supply, comes from the paper available on the market, on the primary market, comes from the diversification on the market. Because again, back to what Jean-Charles said at the beginning, selectivity has to remain the key element for investment process, and strategic allocation brings a lot of value in the portfolio, provided you have the market that allows you to keep your selectivity.
Thank you.
What I'll focus really is in sort of an overview of the asset class that is real estate. Jean-Charles sort of gave us much more sort of an overview of sort of the notion of the choosing amongst the different asset classes. What is important that I want to sort of just in this point discuss is this notion of that historically people have already an allocation to real estate, which is about 5% on average on all sort of pension U.S. plan funds. For those actually who are consider real estate as an asset class, that allocation actually goes up to about 8%. Sort of there's different studies that show this should actually be closer to 10. And when you start asking managers where they would like to actually see real estate, it's a much more higher percentage, going actually in Europe sometimes as high as 15% as a category. Real estate itself. Fundamentally, the problem is that real estate is a very wide and diverse asset class. It's not a very sort of plain, simple product. Colony as a sponsor of funds, we sort of look at it as as a manager of an asset class. Yet at the bottom of a spectrum, you have the purchase of actual assets themselves. Sorry, where you've got a fundamental underlying asset that is effectively illiquid. It's something that requires a lot of effort and time to move. So the essential sort of portion about building products around real estate is how do you sort of mitigate the risk of that illiquidity? How do you give sort of the investors the ability to get in and out, or to sort of remove the decision-making process from the process? Real estate itself also sort of goes across regions, it goes across product types, it goes across risk profiles and cash flow characteristics. So over time, you've sort of seen a huge diverse methodology of investing, going from direct, buying the asset, fully buying the asset with leverage, buying mortgages, to sort of indirect in capital markets, in the form of public vehicles, property companies, or real estate investment trusts, or sort of the sort of newer product that we've sort of seen for the last 10, 15 years, which is property funds, such as opportunistic funds like Colony or Blackstone, or I won't go through all my competitors. What is interesting is when one looks at sort of the notion of the fund, and one looks at sort of how people have the pension fund or the plan funds, because this includes endowments and other forms of fund money in the US. We see that the larger funds have much bigger portfolios where they actually sort of do things directly themselves. The smaller funds, you'll see, have a sort of basically a lot of money in commingled funds, which is in essence sort of outsourced management. So they're sort of commingling risk with other funds and moving out into discretionary opportunity funds and other forms of vehicles. The interesting thing is that as managers, we look at this as an opportunity, because you can broaden the product offering that we're putting into the market. That also brings us back to another question that Marina discussed, which is the notion of, in order to be able to give people sort of the ability to move in and out of these products, because the funds are essentially sort of blocked in for 8 to 10 years, you need to understand the notion of benchmarking and how sort of the managers are actually performing. And that's sort of a big industry call that we're sort of seeing a lot of the large limited partners sort of asking for, sort of fundamental issues of how do we compare sort of different funds to each other's and similar vintages and categories. Sorry, just to quickly sort of give you this idea, as you sort of look up at the risk spectrum and sort of out of the notion of control, at the bottom in real estate, you actually have property assets in the right at the where you actually sort of buy in and out, and as you go up, you get less and less control, but sort of more hands off, to essentially in the upper corner there, where you have opportunistic funds, and it's almost sort of in essence it's private equity, but with a real estate component to it. And I'll sort of come back to that issue in a few minutes. Going back to the actual asset itself, the real estate market is also one that evolves, particularly in Europe. Over the last 7 years of investing in real estate in Europe, we have sort of seen the market become much more efficient. What that has meant is that as an opportunistic investor, it becomes more and more difficult to find the opportunities. You need to sort of start thinking about diversifying your strategies and your product mix, sort of looking at projects that are more operational in nature and less sort of underpinned by an actual asset. It also means that you're going to start looking into new areas and in new markets such as Central Europe or China. And it means also sort of moving down the risk spectrum into the core funds, into the corporate operating real estate, which is sort of a much more sort of hold strategy as opposed to being very dynamic and value added. Within the context as well, at the same time, the competition is increasing substantially as you sort of see the implementation of tax-efficient vehicles such as the French SIC or the UK REIT, and you have an increasing amount of money coming in from other types of vehicles such as the German funds, who were big in the last couple of years as German money sort of flowed out of the stock market into these property funds, who have been sort of big buyers on particularly sort of the large cities such as Paris and London, and whose cost of capital is such that it makes it very difficult to find things that are at a price that where we can find the 20% returns that we're trying to give to our investors. And at the same time, you're seeing a lot more opportunistic players. I mean, here's just in the US, sort of the number of property funds that have been sort of raised over the last few years. And you sort of see that, you know, it's been each year it's been going up. Colony started really at the beginning in 91, when there were just a couple of players, and as the market sort of keeps going on a cumulative basis, that makes a lot of people in the market at any given point in time. To give you an idea, at the end of 2002, the U.S. funds represented $16 billion worth of capital. Sort of looking at the standard amount of leverage that these people would put on the players, that's $50 billion worth of real estate that could be bought and sold. So there's effectively a crowding at that end of the spectrum as well. And then at the same time, you're sort of seeing a blurring of the lines, where you have the non-real estate investors of the world, the actual sort of LBO funds that are looking at businesses that have real estate in it, gaming, hospitality, who are sort of crowding in and sort of looking at it as an opportunity, that are moving into our spectrum of the world. I mean, Colony has been one of the first to actually go into gaming, both here in Europe and in the US. So it's getting more and more difficult to find sort of where do we play. And as a manager, what that means for us is we sort of start to broaden our profiles and start looking at other categories of products, considering sort of going into the more value-added, sort of lower risk spectrum, or becoming sort of product specific, such as the recent fund that we've created for China. Really, in concluding, what that means is that as an LP, the LPs will sort of be taking a bet on a manager who's managing a portfolio of types of products. And that sort of comes down to this notion again of, how do you judge and how do you categorize these managers? Bringing us back to the concept of benchmarking and secondary markets.
Thank you very much. If there are maybe 3 or 4 questions from the floor, now is your chance to interrogate the experts. If not, I have some questions. Okay, the gentleman.
I guess this question for Jean-Charles, or actually you, Marlene. Question I have is, when in your business, obviously you're negotiating with primary equity funds, or at least with those selling shares that I guess they have in primary funds. And I guess I was wondering, if you look backward, whether the relationship you've been having with the sponsors of private equity funds on the primary side has been complementary, antagonistic. I mean, how does a GP control the exit process of one of his limited partners at the time he wants to exit, and whether he does control it, whether we have a veto right on making sure that I guess we don't have newcomers coming into the fund that I guess we may not like to have?
That is a very strong point. We always need consent from the general partner. And I can probably speak for all of us secondaries funds. We like GPs to like us, because otherwise we're out of business extremely quickly. In most situations, if not in nearly all, the general partner is quite happy having a secondaries player in, because it avoids having to spend an awful lot of time going around your typically quite extensive LP base, trying to find out if somebody would want to buy the position that another LP is selling. Having a secondary player do that all for you, it simply means, provided indeed you're happy with the party they are, it means an awful lot less time spent on the whole process. You'd probably, as a sponsor, spend X number of hours in a meeting, due diligence, but you know that these people know what they're doing. They've been through the process X times, hundreds of times before. It is no hassle. And typically, if they buy at an appropriate price, you get an LP in who is very happy. You get exposure to some new LPs within their LP base who you may not have known before, which certainly doesn't do you any harm whatsoever. And it's a very happy relationship in most situations. We know of very few funds who will, by definition, not let secondaries players in because they would always like an LP, an existing LP, to pick up a position for sale. In those situations, I won't mention any names, but those LPs now have so much that an LP who wants to exit actually cannot sell. That is not a good idea. If you're a GP and you prevent your LP from selling, particularly if the LP wants to sell because they have an internal reason. It's not that they don't like you, they just need cash. They have a strategic reason. It's very unkind and very unhelpful to you longer term to say you can't. So by and large, it's a very good and solid relationship that works for a very long time. It just helps enormously knowing a few secondaries players you're happy with, get the deal done quickly, and be able to get on with the life of a GP in the fund. You've got plenty of other things to do. You don't want to bother too much with a complicated transfer process.
And I guess wondering, is pricing paid by the newcomer known to the GP or to the other LPs? Because that's basically the wonderful mark-to-market on basically, how well they're doing.
Typically not. The GPs only in a very limited number of situations have the right to know the price. In most cases, they don't want to know the price. It's a private sale. It depends on the seller situation. If they need something done in a week and we can do less due diligence, some of the uncertainty will need to be worked in the price. It needs to go somewhere. If we have more time, then we could probably pay a bit more. And ultimately, the next seller's position and reason for selling and timing may well be entirely different, and therefore the pricing could be different too. So the GP is typically not interested in the pricing, only if there's a preemption right for existing LPs, and we see very few funds of vintage years of the last 5-6 years that actually have a preemption right built in, because that then goes back to the GP having to go through the whole hoops of sending all the letters out, getting them all back, chasing people for their response, and in most cases they don't want it anyway.
Just another question for Marleen. When you're actually looking at investing the secondaries fund, how much visibility do you typically have on the value of the underlying companies within the fund you're buying, or are you relying more on the reputation of the private equity sponsor?
In most situations, we would have extensive discussions with the general partner. As one spends years and years in secondaries, there obviously is a lot of knowledge about the underlying fund's investments in a lot of cases anyway. The GP has no interest in talking a price up. We find that most GPs, when we speak to them, and okay, some of them can be a bit more over-enthusiastic than others, but by and large, as a sponsor, you've got a real incentive to provide the true story. We get a story, normally warts and all, and there are plenty of warts in year 5 and 6, and it's pretty difficult to hide them anyway, so you might as well just come clean and say, hey, we don't know where this company is going. And that one is great. Well, there's enough of an X year's performance record within the fund that we can actually see that, that makes sense, or no, it doesn't. Having said that, we don't take the GP's word for granted. We still overlay it with our own feeling about, yes, this does make sense, or no, it doesn't. The less information, the lower the price. What I said earlier, that will be worked in there. Little information is no price, then we don't do the deal. That is a typical problem with an auction process where general partners have absolutely no inclination to talk to 10, 15 buyers, potential buyers. They might in the end get one, but which one it is, who knows? And that is a very time-consuming process, and they've got better things to do. So auction processes where 2 or 3 parties are bidding, GPs very happy to talk them through, particularly if they prepare well for the due diligence discussion. A whole different dimension when you get into a big auction and you get much less information because the GP doesn't want to talk to you. You've only got the quarterly report, which may be good or maybe not, depending on.
This is a question about portfolio diversification, but also addressing it into market diversification. And perhaps if I can put it in context first, I'm from MTI, which is an early stage venture technology investor. And venture investment in Europe is very much seen as the poor brother compared to venture in the US. And one of the things that we're very conscious of when we're seeking to raise money ourselves from LPs is that whilst LPs are very conscious about diversification within their portfolio, there tends to be, or there seems to us to be, a bit of a sort of a following of fashion whereby if you're going to do venture investment, you do it all in the US. Is there also, I'm interested in the panel's view on whether there's a need to look at diversification from a market point of view, and so that the total capital flows are not just flowing into one particular market or one fashionable area?
That's a very good question. My background's actually both venture and buyout for various reasons. I'd like Jean-Charles to answer that, but I'd like to say one thing. A lot of, when you look at the statistics for venture and buyout, it's like, and you base your decisions on that in a cyclical, fashion-driven asset allocation market. It's like trying to drive your car backwards through the rear view mirror. And if you take the top 4 exits of US VC funds away from the US VC returns, they look nearly identical to European VC returns. So unless you have been investing in venture a long time, a lot of people really, they just don't understand, there's lack of experience in the asset class from the investor base. So I have a lot of sympathy for what you're saying. Some very sophisticated US institutions do invest in European ventures. The Common Fund, there are a couple I was dealing with over the last months, and they have a very sophisticated long-term view of European venture, that they need to be in there now. They're not really, they know that the market was less good than the US market, but they think the European market is where the US market was in 84 or 94. So they think they're a cycle behind. So they're viewing it in a much more different way than just we're allocating this year because buyout's always been good in Europe, so we're going to stick to buyout. Jean-Charles, you probably...
I completely agree with you that there is a sort of a herding instinct here, and that the European venture market is vastly underfunded at the moment. Dominique Augier alluded to some of the reasons for that. I mean, there are no exits. I mean, if you can't bring your European venture companies to the United States and IPO them there, there are few exits. There are some trade exits. But that's what I mentioned earlier. Think out of the box. I think this is a very good time to really keep close to the European venture community. The US venture is doing well, fundraising, but they have and they have not. I mean, some of the good names are oversubscribed before they know it. There is already a mini bubble effect. Valuations are getting pretty high in the United States. Again, they're not in Europe. So I would view this as a selective opportunity. There are too many VCs in Europe. There are probably 400 VCs in Europe. That's too many. I think that there are probably 20, 25 that are going to survive and thrive. But you really should talk to them.
We've run out of time. So I'm afraid we're going to have to stop it there. Just one note, that last question could also be put to the leveraged loan market and the buyout market. So this point about herding, not following the money, is, I think, crucial to the class and the asset class, and it's come out through all of this. But exactly that conversation about underinvesting in venture because it's unfashionable, over-investing in mid-market buyouts and leveraged loans to mid-market buyouts could well be the next bubble, but we'll have to leave that for Marlene to pick up the pieces later. Thank you.